Let's talk to Chris Weston at IG in Melbourne to find out what he is making of all the data through the overnight period. Good morning to you, Chris. Good to see you.
Good morning.
Tell us about the GDP read, or are we sort of putting that in the rearview mirror for now because all of it now is about the non-farm payroll read that we're expecting out this evening?
Well, yeah, exactly. And I think most people were looking in the looking at that GDP number in the rearview mirror anyway, to be honest, Nadine. It's a Q4 read. It was largely built on inventory rebuild. I think that the inventories contributed the highest contribution since around 1998, about 1.6 percentage points of the 3.6% in total. If you look at Q4 tracking numbers now, we're looking about 1.5%, and so clearly we're going to see a slowdown into the fourth quarter. And if you look at the factory orders last night, they were down 0.9%, and that should really continue to aid that fourth quarter and in terms of lowering amounts. So it is all about non-farm payrolls. That's the big situation. Of course, the jobless claims last night were positive, below the 300,000. I think all in all, what we did see is some pre-positioning coming through there. If you look at the yield curve again, a continued steepening through 250 basis points now between 2 and 10. That's the highest level since 2011. And if you look at the 10-year in itself, it was on the session it was sold off 3 basis points. But we're honing in on those levels that we saw back in September of 3%. So the long end of the curve is clearly moving up in line with what we were expecting. And I think, it's all about non-farm payrolls now. So it's a question of how you position about that. Everyone's running their different playbooks on how the market reacts to certain numbers. Of course, the risk is that we get a number significantly above 200,000. The market's really not prepared for that. And that's when we're going to see the Dow and the S&P continue. I mean, the S&P and the Dow now both down 5 days in a row. That's a fate we haven't seen since the beginning of September. The VIX is up 8 days in a row. So clearly people are buying those put options to prepare for themselves against downside risks in the equity market as well, rather than actually selling out necessarily the physical holdings. So I think that's a positive. But it's all about the non-farm payrolls. If you look at the spread now, it's something like 230,000 up down to 115,000. But I think the market is running with a consensus of March for a tapering exercise. A lot of people are still calling for January as well. We get well over 200,000 and everyone then suddenly says what happens in December will be a realistic situation.
And so we had comments coming from Lockhart, who's from the Fed Bank of Atlanta, so a member of the U.S. Fed. He's saying that a taper should include a limit size or a timetable. So if that happens, if that comes from this upcoming meeting, even if they don't taper, but if they say that they will have some sort of a tapering or some sort of scope around it, will that sort of take a lot of the fear out of the market?
Well, I think we've seen other people coming out, other members of the Fed. I can't remember exactly who their name, but I remember definitely seeing comments from other Fed members saying that they're totally opposed to seeing a limit on the bond buying as well. And I think what's interesting is Jeffrey Lacker is a dove. I mean, he is considered by some to be a more dovish member, not just in their in terms of his inflation and growth forecast, but in terms of his theory on QE. I think he's wanted to see it longer in the market as well. So I think his comments do carry weight. We'll have to see. I mean, I think it makes sense to have some sort of limit on the bond buying program. And if you look at some of the comments we saw yesterday, from different Fed members as well, I think they're clear that certain members want to see a complete end to QE by the end of next year as well. So I think that would be a situation. But I think what we need to remember now is that what actually happens with inflation in the US. I mean, clearly most members of the Fed don't actually see a huge inflation speaking up to that, or QE actually provoking inflation going up to those kind of levels. So that's when we talk about asset bubbles and bits and pieces. But Lacker's comments clearly were very important. But for me, what the most important situation here, Nadine, is the steepening of the yield curve and the way that the market is reacting to the view that the Fed are going to keep the short end anchored. If you look at the Fed funds rate for 2015, at the end of 2015, it's staying around 60 basis points. So the market is firmly of the belief that the Fed will look to taper, and that will probably see some stress in the long end, and we're seeing people position that. But at the same time, the market is now firmly of the belief that the Fed are not going to be raising rates anytime soon, and that's a really big positive, and that's what the Fed are really keen to see, and that's something that they tried to reiterate to the market in August and September, failed miserably because we saw the Fed funds rate moving up to 140 basis points. But this time, I think the market and the Fed are positioned very aligned here, and I think that's a great situation for markets.
Okay, good. Let's just switch our focus to Euro, to the ECB. Interesting. They have refrained from further monetary policy, but said that they're still technically ready. However, that they're comfortable with the settings right now, and that inflation is looking, quote, broadly balanced. So tell us what it all means when it's taken together.
Well, inflation broadly balanced. What is it, trading at 0.9% at the moment. You know, you've got every single European country in the European Monetary Union, the 17 nations, well under the 2%. I think Luxembourg's got the highest at the moment. But you know, they've got a target of 1.2%. I mean, their view is that by 2015, it's the first time we actually got their forward-looking inflation expectations, which well, they'll get it wrong, and they'll clearly have to revise them a number of times. It's what we see from every central bank. But you know, they're calling for 1.3% inflation, which is still 70 basis points below their target. That's not really the issue for me. I mean, they're calling for growth next year of 1.1%, which is above the market's expectation. You know, there are brokers out there calling for 50 basis points, so that's still significantly higher. And it's still pretty lacklustre growth coming through. But the issue that we've been looking at, and I think what most people in the markets were looking at, is what was Mario Draghi's view on negative deposit rates? You know, there was a brief discussion on that, nothing too sinister. I don't think anyone was expecting anything more than that. We've seen the likes of Mr. Asmussen saying that negative deposit rates are something they're looking at, so I don't think that's going to surprise anyone. People were then looking at QE. What do we hear from that? Well, Mario Draghi was extremely vague around that as well. I don't think that's going to necessarily surprise anyone. The Germans, Mr. Schäuble, Mr. Weidmann are clearly opposed to that side of things at the moment. And then I suppose the other situation is what happens with the refinancing rate. Are they going to cut that, say, down to 10 basis points? Well, Mario Draghi avoided that question altogether. And I think with all those things in mind, I think that's why we did see the euro rally quite significantly against the dollar, and certainly against the Australian dollar. I think it's now trading at the highest level since May 2010. So that says to me, I mean, if you look at currency markets in their entirety, people are playing this policy divergence very, very clearly. Now, the ECB don't have any more room from a conventional monetary policy setting left in their armoury. And with the RBA having a clear, non-urgent easing bias in place at the moment, that's why we're seeing this big move up in Euro Aussie at the moment, Sterling Aussie as well, the highest levels in some time, and people are just playing that policy divergence. So the ECB just don't have any more room from a conventional monetary policy left in their armoury.
Do you think that they're willing to take that unconventional move?
The barriers are extremely high. QE requires treaty change, and the Germans, with the rate at the moment, are clearly against that now. I think it would require the inflation rate. Of course, the ECB have a single mandate, and that is price stability. So, I think we need to see inflation getting down towards zero, perhaps having deflationary forces in a number of key economies. That would be one thing. I think we'd need to see liquidity, excess liquidity coming down well below that 100 billion mark. It's about 152 billion at the moment, which is a concern for them because their watermark was 200 billion anyway. And we're going to have to see growth in a number of countries really coming off. Now, the thing for me now is what we've got to look at France, we've got to look at Italy. Their industrial production numbers are coming down. France last night, their unemployment numbers at 10.5%. Were as they put, but that's the highest levels in quite some time. So political issues in those two countries will be the centre of attention for me next year. But I think we're going to have to see inflation forces coming right down, and I think we're going to see that excess liquidity coming right down, and I think we're going to need to see ONIA rates as well, the money market rates, really spiking up, which it could perhaps do as we get towards the back end of this month.
Quickly, Chris, outlook for the market today. Things are feeling quite negative. Where's the focus going to be? Is it around the broader Asian region as well?
Well, I think Japan's going to be opening a bit weaker. I mean, dollar yen's down despite US yields pushing up, which is a bit of a surprise. So clearly Japanese investors are happy to take profits on what's been a pretty good move up in dollar yen. So I think Japan's going to be down. What happens in China is probably going to be more important. We've got a closer correlation there. But if you look at price action in our market, Nadine, clearly momentum is down. We're seeing that in some of the technical indicators at the moment, and I think people will be looking to sell rallies where they can. If you look at the banks, there is a downtrend in the banking sector at the moment. If you look at our market yesterday, we closed at our low, $6.4 billion worth of value going through the market. That's 27% above expectations, which is a huge amount for this time of year as well. So it seems that people are talking about the Santa rally. Well, I think from the price action we saw yesterday, I think there's a lot of people happy to liquidate portfolios, sit on their hands, and just wait for the new year to come out. That's what I took from yesterday's session anyway.
Okay, Chris, pleasure speaking with you this morning. Have a great day.
Thanks, Nadine.
Chris Weston joining us from IG in Melbourne.